My name is CJ Wallace, and the Velocity Channel exists to eliminate your debt and build your wealth. Let's get to it. Section 1, Recap of Velocity Banking Basics. So before we dive into the advanced techniques, let's quickly recap the basics of velocity banking. Velocity banking is a strategy that involves using a line of credit, such as a credit card or home equity line of credit, right? Preferably a first lien, to pay off high interest debt faster. By leveraging the line of credit, you can reduce the overall interest paid and accelerate your debt payoff timeline. Now, I don't know about you, but when it comes to explaining things, I need it broken down to a 5th grade level so that I can understand. And I've actually heard it said before that if you can't break it down into elementary level, you probably don't understand it well enough. So let me see if I can portray to you the velocity banking method in a very simple form. All right, check this out. Now, I know you can probably understand more than the 5th grade level. All right, definitely not calling you a 5th grader. But what I would love about this is you can take any number. Let's say that this is a loan at 6% and this is a mortgage, right? Let's go ahead and add in a line of credit of 15 and 21%, and let's just call this the limit. Okay, so your limit 15, and this is your loan of 200. Usually that's going to end up being $1,200 a month over here, 1,100 cents a month probably, to be more exact. And then over here we have the limit. Now that's your line of credit. Now what are we doing with your line of credit? We're going to be utilizing a portion of that to massively pay down that mortgage. Okay, so let's go ahead and use $12,000 of that, which will be $12,000 at the 21%. The mortgage over here. So what we're going to be doing is we're going to be balance transferring. We're going to take the balance from the line of credit and smash this principal so that now it's not going to be $200,000 that the 6% is eating on, right? It's going to be, I got caught. I didn't do the math. So it's going to be 200,000 minus 12,000, and that's going to equal what? 188,000, right? Listen, you have a calculator. I don't have a calculator. I'm just doing this in my head. Okay, I should have thought about this before. Now, this seems like, well, wait a minute, CJ, you just gave me 2 debts. Really? What if I were to show you that you actually are going to be using the $5,000, right, that you get, let's say, as your income, I means income, and your expenses is going to be $3,000, and you're going to use your line of credit as your new checking account. So where's this $5,000 going after it hits your checking account? That's right. It's going to go into this balance here. So it's not going to be $12,000 balance that you have. It's going to be $7,000. But whoa. Now you have the $3,000 in expenses. So it's going to push that balance back up to $10,000. But what's your cash flow? Okay, that's what matters. The cash flow is going to be $2,000. C stands for cash flow. Now this $2,000, which is amazing, right? Because now we're looking at the $2,000 is what's paying this down, the $12,000. Do you get it? So 12,000 divided by 2,000, how long does it take to make sure that our balance is 0 and we have $15,000 again? How long is it going to take? 12,000 divided by 2,000, which is 12 divided by 2, and that is 6 months. And so what happens when the balance is 0 again? Do you still have the 15,000? Yeah. Can you chunk at the principal again while at the same time paying month? You sure can. Next lesson. All right, section 2, advanced technique number 1, stacking lines of credit. Now, one advanced technique is stacking multiple lines of credit to maximize your debt payoff potential. By strategically using multiple lines of credit, you can take advantage of lower interest rates and higher credit limits, allowing you to pay off larger chunks of debt at a time. Remember, always be cautious when using these multiple lines of credit and ensure you can manage the payments responsibly. All right, so multiple lines of credit. What is this going to look like? Well, it's going to look like something like this, okay? Now, we recommend that we don't have more than 5 credit cards, all right? We don't have more than 5 credit cards. Why is that? Because we don't want on the personal side to overdo it, all right? And that's all. Now, let's go ahead and look at this logically, all right? We got $1,000 line of credit at 40%. We got $2,000 at 15% and $3,000 at 21%, all right? And you may be saying, you know what? I'm taking the least interest one. That's simple, CJ. I'm not going to be taking the 40% one, that's for sure. I just want to focus on, right, the 15% one because it's the lower interest rate. But now, is that something that's wise for you to do? Because what if you had something that was 25 and you really needed to get it? Would you still choose the 15%? Or would you say, you know what? I'm going to go ahead and I'm going to use this card, even though it's a higher interest rate. I really need this education. I really need this tool. I really need this, whatever it is. And say, yeah, but I'm going to go ahead and pay that back before it gets that chunk of interest out of me. All right. And of course, if you need help with knowing how to do this, of course, we have the tools here for you as well. Okay. But let's say you're in that predicament. You can't always say, you know what, I'm not going to, I'm going to pass on this tool. I'm going to pass on this education because I don't want to have the 40% or the 21%. Sometimes there are situations in which you're going to have to utilize, that higher interest card or a line of credit because you really need productive, there you go, expense. What's the productive expense? An expense that you're investing in yourself so that you can grow, so that your company can grow, so that your mentality can grow, so you can get out of a situation that you're in, right? Whether you're a real estate investor, business owner, or you're just a head of family, or not just a head of family, right, man? We need you, right? And, you're in these different spots. Don't be concerned about that interest rate because we're going to show you how you don't need to be concerned about the interest rate as this other thing. All right. So this is section 3, advanced technique number 2. And this is going to involve leveraging cash flow indexing. Listen, cash flow indexing is a method of prioritizing your debts based on their cash flow index or CFI. This is calculated by dividing the outstanding balance of a debt by its minimum monthly payment. Now, by focusing on paying off debts with the lowest CFI first, you can free up more cash flow to tackle other debts, accelerating your overall debt elimination. All right, so this is one that is going to be something they're very familiar with, cash flow indexing. Let's go ahead and give you an example of what we mean by cash flow indexing. We're going to go ahead and abbreviate it by CFI. It's going to equal your outstanding balance. So let me just go ahead and put loan here, balance, okay, divided by the minimum, see there, I listen, monthly payment. Boom. So you're going to be taking your loan balance, each one of them, okay? Doesn't matter if it's 2 loans to 10 loans. Take that loan balance, okay? Let's say one of your loans is $10,000, right? And the minimum monthly balance is, let's just say 1,000. All right. And that's one loan. Then you're going to take another loan. It's 8,000. And that one, man, these jokers are generous. They're only going to charge you $200 a month. Okay. $200 each month. And you're like, man, I mean, that's a choice right there. But we're not done yet. This one is going to be at 3%, while this one is at 20%. Now, which one would you want to pay off first? You're looking at the interest rate again, aren't you? Well, let me go ahead and give you this intelligence, all right? What if I told you if we divided the 10,000 divided by the 1,000, it would give us what? 10, wouldn't it? Okay, so now we have a cash flow index of 10, the $10,000 loan. Okay? While on this side, we would have a cash flow index of 100 for this loan. Do you remember what these numbers mean? What these numbers indicate? Let's go ahead and go over it, right? Let's draw these lines so that we have boundaries here, all right? We have 0 to 50 to 100. Now, we're going to put a line above it, and we're going to label this line, okay? So in between 0 to 50 is what? The danger zone. In between 51 to 99 is what? The caution zone. And between 100 and above, that's called the freedom zone. And why do we call it that? We call it that because of the amount you have to pay in relation to the loan that you got. That's why we call it that. Okay? And so what we're doing here is we're making sure that we're being effective, that we have an effective loan versus an ineffective loan. If it's between 0 and 50, that's labeled an ineffective loan. Look at how much you're shelling out in regards to how much you get on the loan. It's only $200. That's a freedom zone. You never have to pay that back. Just teasing. Okay? You definitely got to pay it back. However, look at how much it's sucking your cash flow. Not much. But look at how much this is sucking your cash flow. It's much. And so we want to make sure that we have the cash flow index in our portfolio and in our minds so that we can implement the right strategies at the right time. Okay? That's why you need the tool. All right? So folks, always remember this. Next lesson. Here we are, section 4, advanced technique number 3, utilizing the debt snowball and velocity banking combo. Who says you have to have an either or relationship, right? Combine the power of the debt snowball method with the velocity banking for even faster results, right? With the debt snowball method, you pay off your debts in order of smallest to largest balance. As you pay off each debt, you roll the payment into the next debt, creating a snowball effect. By using this method, the velocity banking method, in conjunction with the debt snowball method, you can supercharge your debt elimination and reach financial freedom seekers. Welcome back to the Velocity Channel, your bridge to financial freedom. Today, we're going to be diving into some advanced velocity banking techniques that will help you to gain financial freedom. Now, let's do a recap. All right, the debt snowball method. Listen. We're going to be paying off, for those of you that want to do that, the smallest to the largest, all right? Now, of course, if you look at the cash flow indexing method, I believe that's a way better method. However, the debt snowball method is something, if that's what you want to do, you can do it, all right? So let's say you have these monthly payments of 200, right? 200, you got 300, you got 400, 500. Which one are you going to pay off first? All right, so it's the debt snowball method, and that is paying each one off in systematic order from the least to the greatest. So of course you would take the 50 off, which by the way has a cash flow index number of 20. You'd have to pay that off anyway, right? Because it's less than each one of these, all right? So 50, 150, and 300. So once you have the 50 done, where's that $50 gonna go? Now you can buy whatever you want each month? Huh? Not necessarily. Now you're gonna go ahead and pay that extra right here until that's done, and then you're gonna pay, right? 150 plus 50 is 200. And guess what? That's going to go right here. You're going to be paying $500 a month. The lenders are going to love you. The line of credit is going to love you. Listen, your credit score is going to go up like that when you handle your cards and your lines of credit responsibly. Listen, folks, this is what we're here for. God bless you. All right, we're at the end. There you have it, folks. These advanced velocity banking techniques can help you turbocharge your debt payoff and achieve financial freedom even sooner. Now, remember, always use these strategies responsibly and consult with a financial professional if you have any questions or concerns. And if you found this video helpful, could you do me a favor? please, please, please give it a thumbs up, leave a comment, and share it with your friends, share it with your enemies, share it with strangers, share it with everybody, right? And don't forget to subscribe to Velocity Channel for more financial freedom tips and strategies. Until next time, happy debt crushing.